Hey guys, this is Money Value. My name is Olga and today I'm going to tell you about AT&T. So what is AT&T? We'll get to the figures, but you should never invest in a company if you don't know anything about it. So sit down and let's begin. AT&T is the world's largest telecommunication company and the largest provider of mobile and fixed telephone services in the US. Since June 14, 2018, it is also the parent company of mass media conglomerate Warner Media, making it the world's largest media and entertainment company in terms of revenue. And it's also on Fortune 500. See for yourself. Line 9. As you can see on the graph, it was ranked lowest in 1996 and the lowest is line number 93. However, burning the last 20 years, the lowest rank was 39 in 2006, but now you can see it's pretty stable. Actually, this company is steeped in history, but it's not a history lesson, so I'll be brief here. It all started in 1877 when Alexander Graham Bell founded Bell Telephone Company. It had a subsidiary called Southwestern Bell Telephone Company. The thing is, in 1885, the Bell Telephone Company became the American Telephone and Telegraph Company, and later it was rebranded as AT&T Corporation, which had a nickname Ma Bell. Then there was this antitrust lawsuit that resulted in divestiture of AT&T Corporation subsidiaries that are called Baby Bells. Long story short, there were lots of changes, but what we have now is three major players: Verizon, AT&T, and CenturyLink, along with wireless provider Sprint. Also has a very famous partner, Amazon. AT&T reached a multi-year strategic alliance agreement with Amazon Web Services to optimize delivery of integrated solutions. Okay, now let's talk figures. It was a tough year and I'm tired of saying that coronavirus really did a number on business. Anyway, AT&T revenue for the quarter ended September 30, 2020 was $42.34 billion, which is 5.04% decline year over year. The Q4 report, by the way, will be released on January 27. AT&T stock is down 21% year to date, even after recovering nearly 30% from its lows of the coronavirus bear market. But the stock does have a high 6.7% annualized dividend yield in a 1% interest rate environment. Anyway, the stock price is $29.40 as for now. During the 3-month period, the lowest point was $26.50 and the highest $31.46. AT&T's current dividend stands at $2.08 per share, giving new buyers a yield of about 7%. Almost forgot to mention, AT&T is a dividend aristocrat, as the payouts have been increased each year for 35 years now. Wow, that's even longer than I've been to this world. However, AT&T does have some troubles. At a forward PE ratio of about 9, its multiple reflects financial struggle, at least for now. I mean, 9 is well below the minimum of 80 for ideal growth stock contenders. Revenue declined by 3% in the third quarter due to declines in its entertainment group and business wireline revenue. This led to a 22% drop in diluted earnings per share. Analysts predict a 2% increase in income next year, and although this is an improvement, it will likely not stoke multiple expansion in the near term. All those numbers don't leave us a choice but to start talking about stagnation. The stock trades at a level that they first reached in 1995. Even today, it sells at approximately half the price it peaked at during the height of the dot-com bubble more than 20 years ago. You do know there was a so-called dot-com bubble in the late 90s, right? It was caused by excessive speculations of internet-related companies. You can also call it a period of massive growth in the use and adoption of the internet. Bubble is a pretty self-explanatory word, don't you think? Imagine children playing outside. When one of them blows too big of a bubble, the soapy water can't contain air anymore and it bursts. Anyway, let's get back to the subject. The Time Warner deal and before that the failing DirecTV acquisition left AT&T with a vastly leveraged balance sheet with so much debt. In 2020, AT&T refinanced well over $60 billion of debt at historically low rates. They have another $30 billion of debt coming due through 2025, so this additional cash can be targeted here. The moves made to refinance debt reduced AT&T's near-term debt maturities. Anyway, AT&T has a lot of financial flexibility for the next few years. There is something else. Investors were kinda disappointed that AT&T lost its monopoly power. Besides, AT&T and Verizon faced a competitor, T-Mobile. It led to their pricing power being diminished. And one more thing, AT&T is an old company, so it was forced to invest tens of billions of dollars to keep up with the technological changes. It was also expensive for AT&T to try and expand into new markets. I'm talking about them buying Time Warner, Warner or purchasing DirecTV. The last one's numbers are failing, so investors, Elliott management has been pressing the company to sell it. AT&T gave ear to this advice, but was disappointed with the offers. You remember I told you investors were concerned about AT&T not being that much of a monopolist anymore? Well, with Apple releasing a 5G iPhone, the 5G thing is becoming front and center. And since building a 5G network is rather expensive, AT&T has Verizon and T-Mobile as its only 5G related competitors. It doesn't make them a monopolist, but we won't be mistaken to say the word oligopoly. If 5G works out, it would boost the income and help the company connect with its investors better, resulting in the possible stock price growth. Here are some reasons why AT&T is not that popular among investors in their 20s. First of all, the company is an old school one. You could say that AT&T is a victim of a stereotype. Their logo reminds people that the company's roots are in landlines, and in fact 40% of AT&T's revenue come from its mobile service. That is not obsolete at all. Its Warner Media arm is bigger than its Linear and business landline operation, and the consumer landlines haven't been a meaningful business for AT&T in a long time. So this company being obsolete really is a stereotype. Secondly, younger investors are interested in growth, and AT&T is not really about that. I mean, it is growing a little bit, and let's not forget about 5G related potential, but let's face it, this one is more about stability. Those were just some opinions. AT&T still finds its place in many portfolios. Despite the recent decision not to raise its dividend for 2021, it's still a strong dividend payer, and its current dividend yield is still above the market's average payout right now. The company is set to be ready to sell half of its struggling DirecTV unit. Actually, they seem to not be able to get rid of it, as I already said they're unhappy with the offers. However, once that's done, AT&T can focus on promoting its young HBO Max streaming service, or at least leveraging it as a customer retention tool. So, what does it all mean? Personally, I like the tendency of decreasing their debt. Besides, HBO Max is a player in the streaming world with superior production facilities, adding to the potential of share appreciation. Oh, and I nearly forgot to mention that they decided not to raise their dividend, which means they're giving up on their dividend aristocrat status, which would be bad for them too. They have time until third quarter of 2021 to raise and keep the status. Okay, sum up. If you have their stocks, keep them. Watch the management. If they sell such acquisitions as DirecTV or CNN and cut debt, we're probably good. In that case, we might even be talking about buying more stocks. Anyway, now I'm looking forward to seeing the Q4 report, and I hope you are waiting for the new videos just as much. I'll be back with more. See you. Don't forget to smash the like button and subscribe. Take care. Bye.